Hey friends, welcome back to the channel. I'm Iggy, and I've been covering topics like stocks, finance, CPF, and everything related to growing your wealth. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers, with over 950,000 reads and 57,000 likes. I've produced over 800 videos with more than 380,000 watch hours as of May 2025. I also focus on regional and global economic trends. Today, we're diving deep into an SGX-listed giant, Wilmar International. Analysts have a moderate buy on this one, with a price target suggesting some decent upside. But is it all smooth sailing? We'll unpack their business, especially their massive China operations through Yihai Kerry Arowana, or YKA, and see if the numbers and strategy truly add up. Stick around, because I'll share my take on whether this agribusiness titan is a buy, hold, or avoid for Singaporean investors, and how it fits into our local context. Wilmar International is a name many Singaporeans know. It's Asia's leading agribusiness group, a behemoth founded way back in 1991. Their game is an integrated agribusiness model. Think of it like this. They're involved in the entire journey of food, from planting oil palms and crushing oil seeds to refining edible oils, milling flour and rice, and even making consumer products and ready-to-eat meals. This integrated model means they control the value chain, aiming to squeeze out better margins and operate more efficiently. With over 1,000 manufacturing plants globally, their reach extends across China, India, Indonesia, and about 50 other countries. This isn't just a local player, it's a global force in food. Now, let's zoom in on China, a critical market for Wilmar. Their subsidiary, Yihai Kerry Arowana, YKA, is a powerhouse there. You might recognize their Arowana cooking oil with the Golden Dragon fish logo. It's a staple in Chinese kitchens, holding a staggering 40% of China's edible oil market. This market consumes nearly 40 million tons annually, so that's a huge slice of a very big pie. YKA's IPO on the Shenzhen Stock Exchange in 2020 was a massive success, raising around the $2 billion. The demand from retail investors was through the roof, oversubscribed by almost 3,500 times. This tells you how much confidence local investors have in the Arowana brand and YKA's market position. For Wilmar, YKA is clearly a crown jewel. So, what's Wilmar's strategy, especially in China with YKA? It's all about downstream expansion. They're not content just crushing and refining. They're moving deeper into consumer products. This means things like noodles, pasta, and even developing specialty products like high diacylglycerol, DGA oil, marketed for its health benefits. A key part of this is the central kitchen concept. Imagine large-scale kitchens preparing food for restaurants, food delivery services, and consumers. YKA already has one of these in Hangzhou and is building 11 more, expected to be ready in 2025. This is a smart move to boost factory usage and returns, tapping into the growing demand for outsourced food services in China. They are also making huge investments like a 10 billion yuan food complex in Jiangsu, the largest in China's east, to serve the Yangtze River Delta market. This shows a clear long-term vision to dominate the Chinese consumer market. Let's talk financials and outlook. For FY 2024, Wilmar reported revenue of over $67 billion, but net profit came in at $117 billion, a decrease from the previous year. They paid a total dividend of $0 per share for FY 2024. Looking ahead to FY 2025, the company is cautiously optimistic. They expect their oilseeds business to do well, helped by a predicted record soybean crop in Brazil, which should mean lower raw material costs. They also anticipate consumer sentiment in China to keep improving, which is vital for their food product sales. Analysts currently have a moderate buy consensus on Wilmar, with an average 12-month price target of $3.46 as of mid-May 2025, suggesting a potential upside of around 12.76% from its price at that time. The company's chairman also repurchased shares in late 2024, which is often seen as a sign of internal confidence. Now, for my take, the moderate buy makes sense, given Wilmar's market leadership and strategic initiatives. I agree that the downstream expansion in China, particularly the central kitchen concept, holds significant future potential. This move into value-added products can improve margins over time. The Arowana brand's strength in China is undeniable. However, I think investors need to be mindful of a few risks. The recovery in Chinese consumer sentiment, while expected, could be slower or more uneven than anticipated. Competition in the food products space is always fierce, and as an agribusiness, Wilmar is always exposed to commodity price volatility and weather-related risks. On the opportunity side, the planned acquisition of a larger stake in Adani Wilmar in India could significantly boost profitability from 2026 onwards. India is another massive consumer market. The development of healthier product lines, like DGA oil, also taps into a growing global trend. For us Singaporean investors, how does Wilmar fit into the picture? Dividend-wise, $12 per share isn't a massive yield at current prices, but for a company focused on growth and reinvestment, it's a reasonable return. If you're investing your supplementary retirement scheme, SRS, funds, blue-chip stocks like Wilmar could be an option to consider for diversification, aiming for long-term growth rather than just high immediate income. Remember, SRS contributions offer tax relief, and investing those funds can help your retirement savings grow. CPF Ordinary Account, OA, funds can also be invested, though there are limits on stock investments, currently 35% of investable savings. It's crucial to align such investments with your overall retirement strategy and risk appetite. Wilmar, being in the essential food sector, has a certain defensive quality, but its performance is still tied to global economic conditions and consumer demand. Singapore's own 2025 growth forecast is a modest 0 to 2%, with the global outlook still a bit cloudy. While Wilmar's main markets are outside Singapore, global sentiment does play a role. Local policies like Singapore's 30 by 30 initiative to produce 30% of our nutritional needs locally by 2030 highlight the importance of food security, an area Wilmar operates in globally, though not directly contributing to Singapore's local production targets with its current structure. If you're finding this in-depth analysis valuable, imagine the level of detail you'll get with our daily premium content. For just $1 a month, you can become a member and unlock exclusive insights, deeper dives, and more to help you navigate the Singaporean investment landscape. Don't miss out on this opportunity to level up your investing journey. The link to join is in the description below. So, to sum up, Wilmar International is a formidable player in the global agribusiness scene with a particularly strong footing in China through YKA. Their downstream expansion strategy, especially the central kitchen model, looks promising for long-term growth and profitability. The company is navigating a complex global environment, but the outlook seems cautiously positive, supported by potential improvements in consumer demand and raw material costs. Key things to watch are the execution of their China strategy, the performance in India, and how they manage commodity risks. For Singaporean investors, Wilmar offers exposure to the resilient food sector and growth in Asian consumer markets. However, as with any investment, consider your own financial goals and risk tolerance. Is it a strong buy right now? Given the current valuation and the risks, I'd lean towards a hold for existing investors. And for new investors, perhaps waiting for a more attractive entry point or further positive signals from their China operations. The long-term story is compelling, but patience might be rewarded. Keep an eye on their quarterly earnings and developments in their key markets.